Starting out here, hello and happy new year. Thank you for joining us today for our economic and market outlook live stream. We are glad you are here. My name is Jason Ranallo from Vector Wealth Management. For those that are new to Vector, a little bit about us. Vector is a full-service wealth management firm specializing in investment management and retirement planning. If you'd like to learn more about Vector, please visit our website at vectorwealth.com. Before we get started, a brief regulatory statement. All content is for informational purposes only. It should not be construed as individual advice. Different types of returns have varying degrees of risk, and past returns are not indicative of future results. Today, we're going to have a discussion on market trends and share some economic insights. We're going to do 20 to 25 minutes of prepared remarks, followed by a Q&A session. Now, without further ado, I am excited to introduce Kara Murphy, Chief Investment Officer of Kestra Blue Spring, who's joining me today for this discussion. Kara brings top-notch insights when it comes to market analysis and economic views. You may have seen her on CNBC or Bloomberg TV, where she's a regular guest contributor. Kara, thank you so much for joining us today for this discussion.
Thanks so much for having me. Always great to be here.
Kara, I'll turn it over to you to start the presentation here on investing and Barbie.
All right. Well, I've been in this business for a long time, and I find markets incredibly interesting. But I found that sometimes when we can bring in a little pop culture, we can make it a little bit more accessible for folks who don't spend their days like I do, nose deep in spreadsheets and charts and everything else. So we're going to go on a little trip. Some of you may have, Barbies in your past, but even if you don't, hopefully you'll get something from this. But we do like to often kind of incorporate these themes. And for this exercise, I'm going to ask you to look at 4 different types of Barbies. There have been many, many different Barbies over the 70 or so years that the doll has been around. We have Malibu Barbie, Totally Hair Barbie, George Washington, and Chewbacca. And I want you to look at these 4. And with the limited information that you have, I want you to guess which of these was the best-selling Barbie of all time. And I will tell you that I got this wrong when I first started this exercise. And often when I ask people, they also get it wrong. The most common answer that I get is Malibu Barbie, which was around for a very long time. But the correct answer is Totally Hair Barbie. You'll see that very long hair kinked that was iconic in the 1980s. And you know what? I should have had a leg up in this. Because I grew up in New Jersey in the 80s. That was like the home of big crimped hair when this Barbie was selling. You'll see here, this is me at my junior prom. I did not include the photo of me and my date who had even bigger hair than I did. But you'll see even when I had short hair, I had big hair. Even my dog had big hair. And I still got this one wrong. But here we'll do another exercise. And now that we know exactly which Barbie was the best selling of all time, the other question is, what's the most valuable today? And if you look at each of these, it becomes a very different calculus. And I will tell you, I have to break the news because it kind of breaks my heart, but Chewbacca Barbie is actually the most valuable today. So if you go on eBay, as I did, doing a lot of research for this, you will find that in order to buy yourself a Chewbacca Barbie today, you have to fork over $800. So it's a great example to me of how even if you have the perfect information, which is very difficult to come by, it still doesn't necessarily tell you how people are going to think about value today. So we know that Totally Hair sold more Barbies than anybody else. But today, people are paying more money for Chewbacca than anybody else. And mind you, Jason, I love Star Wars. My whole family loves Star Wars, but a Chewbacca Barbie, to me, is an abomination. But go figure. There are collectors who pay a lot of money for it. But it's just a good example of what we do as investors. We try to get as much information as we can, knowing that we're never going to have perfect information. And then we try to forecast how that information is going to impact value in the future. So before we go looking into the future some more, though, let's take a quick look at the past. So this particular chart is looking at returns over the last year. So the first thing that's interesting is that every one of these bars is positive. So that's a pretty good year. Usually you have some up, some down. The other thing I'll draw your attention to is all the way over on the left. That's US large cap stocks, 25% in a year. That is after more than 20% return in 2023. So that is back to back. We had two very, very strong years for stocks. This is unusual in how strong they were. Now, if we look at, say, emerging markets and developed ex-US, those are also quite strong years, but not nearly as much as the US. So it doesn't feel as great. Now, switching to the next slide, looking at the economic dashboard, we put this together to kind of give a sense of what's happening in different areas of the economy. And we can talk about each one of these if you're curious. But I'll note in particular up top monetary policy. There's a reason why that's on top. And that's because when I started in this business on Wall Street 25 years ago, my boss drilled it into me, don't fight the Fed. What that means is that if the Federal Reserve is trying to stimulate the economy, that is good for stocks. Don't fight it, ride the wave. If the Federal Reserve is trying to slow economic activity, don't fight the Fed. That's not good for stock. Well, right now, what we saw over the last year is that the Fed cut interest rates for the first time in September and the second time in December. That is generally good for the economy and generally favorable for stocks. Now, the reason why that lever is not all the way into the green is because the pace at which the Federal Reserve has been cutting interest rates has been much slower than what was expected. Now, with that, let's take a quick look at what you might think what you may have heard of as the Magnificent Seven. So over the last 2 years, there have been 7 stocks. And if I was really going to put everybody to the test, I'd ask you what those 7 names are. But think like Meta, Google, Tesla. They're all, names that you've heard of, NVIDIA. Over the last 2 years, these 7 names have had really extraordinary performance. So that dark line here is looking at just those 7 stocks over the course of 2024. And you can see how tremendous that return is, up 160% in a year. That gold line is the S&P 500. So we've already talked about how that's a really impressive return, but it doesn't look so great compared to the Mag 7. That green line then is small cap stock, so the Russell 2000, where again, like a decent return, but doesn't look very impressive compared to some of these other names. Now, I get a lot of questions about the Magnificent Seven. Is it real? Is this a repeat of the tech bubble? And what I would say is that importantly, these stocks and their success have really been underpinned by very strong earnings growth. So if you track over time how big, so that top line is how big collectively those Magnificent Seven stocks are. How much of the S&P 500 do they make up? So you'll see in 2014, collectively, those 7 stocks made up about 10% of the S&P 500. But they also contributed about 6% of the earnings. And what you'll see there is those two things grew together. So as earnings for the Mag 7 grew, so did the size of those companies. So that makes sense. Now, what I would say, though, is that those two lines have started to diverge a little bit. Even though earnings are continuing to grow at a very impressive pace, they are falling behind the growth of the actual stocks. But what I would say is right now, these are the darlings in the market. These are kind of, my mom often calls me at night and will want to talk about NVIDIA. And she's not like she's a former English teacher, and so doesn't spend a lot of time thinking about investments. But NVIDIA has come so to the forefront of people's imagination and their focus that they're talking about it a lot. I think of it a lot like Barbie, right? These guys are the ones who have all the great earnings. Everybody's watching them. They got the perfect hair. But I will admit, I was not a big Barbie fan, actually, when I was a kid. Most of my Barbies looked a lot more like Weird Barbie. I like to cut their hair and draw on them, whatever. And I like to think that that's part of what makes me an investor, is that I like looking for the things that are not perfect. I like looking for the opportunity. And the good news is the market continues to have a tremendous amount of opportunity. So one example that we'll take a look at is looking at earnings growth for the Magnificent Seven versus everybody else. So in the previous chart, we looked at growth in earnings for the Mag 7 over time. That's those blue bars. So you can see very, very strong growth over the last few quarters. Those gold bars are taking every other name in the S&P 500. And you can see that that earnings is much less impressive. I'll call attention to the third quarter of 2023, where the Magnificent Seven were growing their earnings by 60%, and everybody else actually saw declining earnings. But again, the market is about looking forward. It's about forecasting what people are going to consider valuable in the future. So if you look over to the right, those shaded bars are estimates. That's what collectively analysts think these companies are going to earn in the future. And if we look at those last two sets of bars, by the fourth quarter of 2025, the Mag 7 earnings growth is expected to be about 21%, and all the other stocks in the S&P 500 are expected to be about 17%. So that's actually very close compared to what we've seen in the near past. So what that means is that the market is really left behind a lot of those other stocks, even though they're going to see really strong growth going forward. Now, we're happy to dig into any parts of this that you're curious about, but I do want to, we're looking at a very kind of like near term trends in the market. And I do want to zoom back out for a moment and just remind everybody, we think a lot about kind of ticks and turns in the market, but this is looking at different asset classes over a 200 plus year period. And what you'll see here is that stocks, that's that line all the way at the top, stocks far and away have proven to be the best way to build wealth over time. You'll see bonds do a pretty good job with less volatility, but these other asset classes just don't have the 200 plus year track record that stocks do. In the near term, they can be volatile, but over the long term, they're a tremendous way of building wealth. So I say that to just caution. We can think a lot about what's going to happen next year, but if you're thinking about your financial future, that's probably more than just next year. And stocks can be a great way of driving that growth. So with that, Jason, I'll hand it back to you.
Yeah, thanks, Kara. Great insights on there, especially as it relates to those Mag 7 companies where you're right. A lot of times it's easy to focus on those. They pulled a lot of weight and to your point too, a lot of earnings too. And that's great that investors broadly can participate in that. But it's also a good reason that as we think about investing and looking forward too, is where do we want to invest going forward? And where do we think there's opportunities going forward? And there's a lot of other asset classes and segments of the market that we believe are worth paying attention to. The Mag 7, that divergence that you showed up there a minute ago, it doesn't necessarily mean the Mag 7, those big companies have to fall down for the rest to catch up. It can mean that the smaller ones just start to catch up.
Absolutely.
We're not going to predict which one's which, but I think one of the key takeaways here is there's other segments of the market that are worth paying attention to, especially after what we've seen the last couple of years. And it doesn't mean that there's an imminent market decline, especially with those Mag 7. It could just be that the smaller companies and the medium-sized companies start to capture more thrust in price movement, and that can be a great thing too for investing.
Absolutely. And like picking that turning point is extraordinarily difficult. So what you want to do, you have to make sure you're there so that you're ready for that turn. And then if you have a diversified portfolio, then you're going to have exposure to a lot of those different areas of the market. But, I didn't show, we have another chart that shows the Mag 7 in 2022. Collectively, that group of 7 stocks declined by 50% in that year. So it's important that's only a couple of years ago that those stocks lost half their value. And that's another reason why we have diversification in order to smooth that ride out.
Yeah, exactly. And the pain, of course, of when markets go down and just the math behind it, right? If you fall 50%, you need a double to get back out of that.
Absolutely.
And so while when they're doing well, it can feel like, gosh, I wish I had more of that, or I wish I was participating more with that. There are times when these things go through different cycles, and to be diversified across a variety of asset classes, we again firmly believe that makes sense to be diversified.
Yeah, for sure.
With that, we had some really good questions that came in before the.
Jason, you have some smart clients. You showed me a couple of the questions. They're very interesting.
Yeah, for sure. And I'm going to we'll go through some of these, and if there's others that people want to enter into the chat, please do. But I want to kind of go through some of these questions that came in here. And the first one I want to hit on, this is one that we get a fair amount, I think, for good reasons too. And it's related to the U.S. debt as a percentage of GDP and how it's been increasing, and kind of think about investing in 2025 and beyond, right? Because at some point the question goes on to ask, will investors want to buy our bonds? And how do we think about investing throughout that? And so to kind of dive into that discussion is kind of setting the table a little bit. So just from a numbers perspective, U.S. debt is at $37 trillion in total. The interest cost on that alone is now exceeding several other government expense items. I think it just recently crossed the defense budget amount.
Yeah.
It's very clear that it's growing and it's been getting larger. Now, what we think about is how does that get fixed and what are the ways to do it? And the thing I think we'd point out is that there's not one single magic way that this gets solved, right? What it comes back to is we need to, most likely it's going to be a mix of growing our way out of it from an economic standpoint. So economic gains, growth in the economy, potentially inflation, right? Inflating our way out of it. Think about paying off your mortgage, fixed rate mortgage with an inflating income. It gets easier to afford those payments with inflation. Think about in terms of potential spending and or tax reform, right? There's a multiple of ways, and most likely it's going to be a mixture of all of those because it's going to require a lot of different components to fix and kind of, I don't know, say right the ship in a sense of getting that more under control. What is the net effect of it? Possibly we could see a resurgence in inflation again. Some of the data we've seen lately is showing some signs where inflation could be ticking up again, and that could be something where we see inflation start to pick up. Perhaps not back to what we saw a couple of years ago, but inflation could be reaccelerating. Coming back to the question, though, in terms of how do we want to invest throughout that? Importantly, and this goes to that long-term chart that Kara had up a moment ago around the 200 years. We look over long time periods, owning assets that outpace inflation and that have the ability to grow and compound wealth, we think are still going to be an important piece. And that's going to be heavily driven by stocks, broadly diversified, owning stocks, assets that can outpace inflation and diversify away from just owning, for example, government bonds. There can be a temptation when government bond yields are at 4, 5, or 5.5%, like they were a couple of years ago, that's the best type of yield to lock into. But over long term, we still believe other assets, again, such as stocks, are a good asset to own to help diversify and outpace inflation.
Jason, it might be helpful. We have a chart to kind of demonstrate some of this challenge. And on the left, you'll see, as you said, public debt as a percent of the total size of the economy is off the highs during COVID, but is extraordinarily high. But if you look on the right, that's how much it actually costs to pay off the government debt. And for many years, people would ask me if this was an issue, right? Like, when is our debt going to catch up with us? And I was like, well, as long as people keep buying our bonds, it really doesn't matter, right? To your question, or to the original question. But the challenge is now with interest rates higher, this line on the right is going to continue to go higher. And I think just the fact that you had a long list of different ways that this can be resolved, and you said it's probably going to be some combination. I agree. And I think that goes to the point that this is a really difficult problem to solve. And I will also say it's an American problem. Every single American president since Truman has increased the federal debt. So nobody's been able to come up with an answer for it. But it's also one that will take time to unwind.
Another question came in related to M2, the money supply. It's on the rise. Historically, this has been good for stock markets, was generally the question. Any thoughts as to rising M2? Will that be positive on a go forward? And so M2, think of that is a measure of the money supply, and it has been on the rise. We have seen that increase. Historically, there have been periods of time where rising M2 or money supply, it's been more liquidity into the economy, and it has boosted asset prices like stocks. The one thing we'd note, though, is that it's not always a tight correlation and an immediate effect, meaning just because M2 goes higher in a particular quarter or 6-month or 12-month period, it doesn't necessarily mean that on a go forward that stocks are always going to be moving higher. While there can be more liquidity in the economy and that can be a tailwind for stock or other types of risk assets, the correlation we've seen is somewhat broken down. That's not always a tight connection between the two. Moving along, a few other questions coming in. this is a good question around productivity growth. We mentioned NVIDIA earlier. The question is, how do you balance potential productivity gains from AI or artificial intelligence with a combination of consumers and the U.S. government being strapped when forecasting forward and looking at different types of assets to invest in?
Yeah, it's a very complicated picture, right? Because there are a lot of different moving parts there. So I'll pull them apart a little bit first. And one is that I think the true kind of promise of AI is the long-term productivity boost that AI will provide. And I would argue that we're still really in the early stages of figuring out how that's going to happen and how it's going to play out. I know, Jason, I don't know if you're like me, but like I have Chat GPT up on my screen a lot, and I'll just be like, oh, I can try this out. So I'm still, experimenting and trying to get an idea of how it can help make my day easier. And then so imagine that like for a factory, right? Or a call center. So there's a ton of work happening there. And what we've seen is that the US worker is already the most productive in the world. So we have a great starting point, and it's probably going to get even more productive. The great thing about that is that the economy can grow without inflationary pressures, right? Because you have this same worker who can do a lot more, and then you don't have the prices running up along with it. That's great. The challenge, and I think this might be implicit in the question that you asked, Jason, is that it's not necessarily good for our consumers. And I think it's still a question mark. So it'll grow generally the overall economy, but may not benefit everybody equally. And so what we've seen is that there are certainly like certain types of American workers who have kind of been left out of this economic recovery and maybe haven't benefited from some of the improvement in the economy that others have. And so just because the economy is growing doesn't mean that everybody's enjoying that lift. And so I think that is something that will be a challenge for policymakers.
We had a question come in also on M&A activity, and I believe we have a chart on this too, if we could pull that up. It was related to mergers and acquisitions, small businesses, and if we anticipate more strong deal flow, any noticeable shifts in valuation trends or buyer appetite. If we could pull up that chart, and Kara, if you don't mind digging into that.
We've been watching this closely because you can see on the left, overall deal activity around the world came down pretty significantly in the post-COVID era. And that's a combination of weaker economy, higher interest rates, which make acquisitions more costly to do, and I'd argue greater uncertainty about the macro environment. But what we're seeing now, there's a little bit closer view on the right where you can see is that deal volume is starting to pick up again. We would anticipate it to look a little bit better into next year. One thing that would really juice M&A is lower interest rates. And what we've seen, I mentioned earlier that the Fed has just been a little bit slower to cut interest rates than what the market had hoped. So there's some benefit, but not a huge amount relative to interest rate levels over the last couple of years. But generally speaking, this type of M&A activity should help smaller and mid-sized companies as they have more opportunities to get bought up by larger companies.
Yeah, it's always, when you think about too, you mentioned it, is the interest rate, the cost of borrowing, and how much and how many different segments of the economy that impacts. It touches virtually everything in terms of the cost of borrowing, the cost of capital, and that impacts certainly M&A. And another question we had come in was on real estate and REITs in terms of how are REITs attractive? Is real estate attractive? And I know the housing market, we hit on that a bit ago with the kind of the outlook slide and the economic outlook. But you think about the trade-off investors broadly are making in terms of if you can invest in a real estate investment that might pay you 5% or a treasury that can pay you 5%, right? That trade-off is, say, much more debatable now than what it was maybe 5 years ago when you could earn 1% on treasuries and 4 or 5% on real estate plus some price appreciation, and of course tax benefits depending on how you own it. But the point being is interest rates come in as they rise and come into the picture more than they were again 5-6 years ago. That causes participants in the market wide to reassess the attractiveness of that, and that's why I think housing is a great example because can be a real local level and personal level. Is right if mortgage rates are at 6-7%, the cost of a new mortgage and on a new home is, it's a much different calculus than what it was just a handful of years ago.
Absolutely. Although I would admit too, I would have expected housing prices to be down more than they have, given how high interest rates have been. It's pretty remarkable how home prices have really hung in there.
How about the new administration? They're about to take control in Washington. They suggested that they'll be more pro-business, perhaps stock market friendly. If so, what are the best categories to be invested in? Good question. Generally, yes, that, if the administration is viewed as being more pro-growth, pro-economic activity, that can be good. But again, I'd go back to the timing of when these things can happen is not always neatly tied out with perhaps just a new administration taking office in whatever it is, 5 or 6 days. Again, the market's going to be discounting things into the future. And I'd say the bigger impact going forward are going to be the level of interest rates, the level of inflation in the economy, as well as just the ability for the economy to grow. Those are going to be the bigger driver. Over the long haul, as we look at different administrations come in and out, and Kara, you mentioned earlier, debt levels have risen under both types of administrations. I think the market now having more clarity since November as to kind of what the administration is going to be like going forward, that's removed some uncertainty. And of course, the markets dislike uncertainty more than anything else. So, again, I would tie more back to what's the level of interest rates, how are interest rates changing, what's the Fed doing, what's inflation doing, and then how is the economy growing throughout that time period.
Jason, I'll mention a couple additional things. And I totally agree. This is another example of where you don't want to get too far into the weeds because there could be a lot of policy changes that end up not having a really big impact. A couple of areas that we're focused on. One is on tax policy, and that the taxes that Trump had initiated in his first administration are likely to be extended. So that's more same. And here's a look at tariffs, which was mentioned in the question. And I would expect Trump to make a big splash on tariffs kind of early in his administration because it's sort of an easy lever to pull. And these are just some examples of how the expected policy has impacted some stuff in the market. So on the left, you'll see that dark line is semiconductors, which are largely made outside the US, and then software, which is largely made in the US. So post-election day, what you saw is software performing much better than semiconductors, with this idea that semiconductors would be hit with tariffs, whereas software would not. And on the right, you'll see that red line is a basket of stocks that are expected to perform better in a Republican administration. Blue is stocks expected to do better in a Democratic administration. So you could see pre-election, they're sort of like going up and down. Election happens, and all of a sudden the red basket takes off. But what's interesting is that you see that there's not a lot of staying power there, right? Those red stocks started to fade then in a couple of weeks once the election was done. And we see that often in prior election cycles, areas of the market that, prognosticators were saying would do really well under this type of administration have a boost, and then they sort of fade. And it's all the things that Jason listed that end up having a bigger impact. If I may, I'll also mention Bitcoin. I saw that came up in another question. That's that gold line in that right chart. And you can see that once the new administration was identified, Bitcoin really took off and has been a little bit more volatile lately. And so I think that really is a clear view on regulation and how Trump has come out pretty strongly wanting to be more sort of supportive of crypto in general from a regulatory perspective. And that was really driving a lot of interest there. Now, again, we'll see if it lasts. But that was one area of the market where we saw a big move.
Yeah, it's a great example. I'm glad you hit that too, as that question did pop up in the chat. Is that, again, the market's moving based on expectations of some future event, right? So Trump gets elected, the market is expecting something to occur, something to unfold, whether it's in the cryptocurrency market, regulations, whatever it might be. Therefore, the market's moving today based on some future event. As you get closer and closer to that, right, every day, every moment, the market's weighing that outcome, and adjusting prices instantly. And as it gets more certain or uncertain, you can see more volatility perhaps in that asset segment as well. And crypto or Bitcoin and cryptocurrencies can be the same kind of treatment as far as how participants are viewing it.
Yeah, very interesting to watch.
We did have a question come in on, this was more from a planning discussion. I'll kind of hit this high level, but it was around valuing the value of shifting from an IRA to a Roth, so moving money from a pre-tax individual retirement account into a Roth, effectively doing a Roth conversion. In short, yes. And the question was, can you do that to reduce or avoid the tax hit? There's some great analysis we can put together on that to put together a projection for you on that. And we can follow up with you after this call related to that. But in short, yes, it can make sense depending on tax rates and projections and kind of think about income today versus income in the future. And we can help kind of create a balance or create a kind of a decision tree for what can make sense for doing a Roth conversion. So good question. And we will certainly follow up with you after this to get into more details on that, because it tends to be a case by case situation on that piece. The other one related kind of to that too is question on, are 529 plans a good investment? And if so, can the funds come from IRAs without tax? 529s can be a great way to save for college funding. Money grows tax-free, it comes out tax-free. Whether it can fund from an IRA, I will need to confirm that and follow up. I'm pretty sure you cannot do that, but I can double check. I do know that based on recent tax law, going back to 2023, individuals that have excess money in a 529 after, say, your student or your child is done using it, if there's still excess dollars in that 529, there are ways to convert that to a Roth IRA for their benefit. And we can dig into that more too, because it's some pretty neat ways to take money out of a 529 later on that didn't end up getting used for qualified school expenses. Again,
I got 3 kids approaching college age, Jason. So because I've been thinking a lot about this stuff lately.
Let me just check, see if I have any questions. Oh, here's another one came in. With all the natural disasters this year, hurricanes, fires, how do these impact the economy and the market? Great question. Obviously, the West Coast and the folks there, we keep them in our thoughts in terms of what they're going through. It's quite a huge development going on with the fires in California. Yes, there are going to be some impacts. I'd say from the insurance side of things, it's likely we'll see impact across the insurance industry just because of how much of loss has occurred over this time period. And so the magnitude of the current fires are much larger than we've seen in the past. And so it's quite possible, or most likely, we'll see that impact the insurance market. We look at the reinsurance market a little bit. We haven't seen a huge impact there. I think it just has to do with how much of it's actually insured losses at the reinsurance level. But that's more from like impacting reinsurers. As far as how it impacts the stock market, I mean, the market, again, think of it in terms of it's always going to be discounting and pricing based on information today. And it hasn't had a huge impact yet on that. What it's going to probably come back to in terms of what could be perhaps more isolated events in terms of rebuilding the area. What are the supply and demand needs in terms of housing, in terms of people being dislocated from the area? And so it's possible it could end up being more isolated to one area. We haven't seen it spread broadly to the stock market, of course, as we just look at in terms of prices alone. But it's something that certainly could and will impact the insurance market. And we'll see that across the country most likely.
But Jason, I'd add one other thing too, because unfortunately these things are coming with greater frequency. Size is bigger, frequency is bigger. And as you think about the increasing level of uncertainty for businesses, right? You have to plan for this more uncertain environment. For individuals who have to plan for a more uncertain environment, have to pay more for insurance. All this does is sort of add cost to the cost of doing business or the cost of, budgeting for your family. And in general, what it should do over the long term is just dampen economic growth a little bit. So far, as Jason said, we haven't seen really big impacts on a macro level in terms of how the stock market has performed or anything. But over time, it will take resources away from other things that we could have spent money on. And I think that's something that from a policy perspective and as individuals, we still need to really think about. I was talking with a family on the coast of Florida shortly after their back-to-back hurricane. This woman didn't have damage, but she was worried. And she's like, what do I do? And I was like, unfortunately, you have to carry, excess savings to be able to handle those kind of uncertain events going forward.
All right. Just checking through to see if we have any other questions that came in. Okay. There's another question here in terms of time horizons. And related to types of assets to own at various time horizons, stocks for the long haul versus other types of assets. It's a great question as we think about building a diversified portfolio and how we think about planning for someone retirement. So as individuals, families lead up to retirement in that accumulation phase, oftentimes it's more about how much you're setting aside every month, every year, and the growth you get on that. And you have the ability potentially to be more aggressive, more growth focused as people enter retirement. and they're looking to withdraw assets from their portfolio, that's when we really lean into using a bucket-based approach to planning and investing. What we look at doing then is making sure we have dollars set aside for income needs. It's one of the most important things I can tell individuals as they're approaching retirement, that if you're within 1 to 3 years of retirement, that we got to make sure we have income needs set aside in something that's stable, that's reliably there, so that we don't have to have someone's income need impacted by the movement in the stock market. Stated another way is we don't want to have to be forced to sell stocks in a down market to fund someone's income needs. So by splitting that up across different time periods, it does often then make sense to own other types of assets as you get closer to retirement, like short-term bonds, like ladders of CDs, whatever it could be, to make sure we have income needs set aside and structured. We look at it, it's a bit of a, oftentimes think of kind of as an airplane, coming into approach or taking off, right? It's not always just a level, asset allocation over time. Those asset allocation, the investment mix can change over time, and it should change in our view based on how individuals are spending and living their life. So it's a good question, and something that as we balance and look through and planning for the future, that we want to make sure we incorporate the ability to change the investment mix to align with how individuals are spending. All right, with that, we are at time. Really appreciate everyone tuning in today. We recorded all this information, so we will put this out for on-demand view later on our website, as well as send it around via email. Kara, thank you so much for joining. This has been really insightful. I always appreciate the discussions. And as anyone on the call too, if you're interested in learning more about Vector, you can go to our website at vectorwealth.com.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or